We just talked about long-term investments. Let's now move to short-term investments, okay? So we're going to be talking about inventory, right, which is an investment that a company has to make in the short term in order to sell goods. And we're going to talk about receivables. And at first, it may be strange to think about accounts receivable as an investment, right? So things like trade credit, consumer credit. Why is this an investment in the business? Okay? Let's think about that. Why does a company have receivables? Okay? The reason really is that it may be necessary to give for a company to give some terms, to give time for customers to pay for the goods, right? So having a receivable is a necessity of the business because it can increase the demand for your products, right? It gives better terms for customers. If customers have time to pay for whatever you're selling, that might increase demand. On the other hand, receivables are going to tie up cash, right? Because you're giving customers time to pay for the goods, it's also going to take longer for cash to come in, right? And cash is, of course, going to be an important consideration, okay? So how could a company reduce receivables, right? Of course, the first issue you might want to consider is whether it's worth giving discounts, right? Companies can usually trade off receivables for discounts, so maybe you can give discounts for customers to pay early, right? But you will quickly realize that this is going to be costly, right? Discounts are going to reduce revenues, okay? There is an alternative, which is to factor receivables, okay? Let's see how that works. If a company has, for example, $300 million in receivables that you generated because of your business, let's say actually that these receivables are due in a year, okay? The company has two options, right? You can wait a year to get paid, right? Or you can try to get the money now, right? And you can think about how could the company get the money now, right? You can go to a bank, for example, and tell the bank, look, I have a receivable, I have some accounts to receive in a year. Can you give me some money now, right? Or a factoring company. That's exactly what a factoring company does, is to buy receivables from companies that have them, okay? So, of course, that's going to have a cost, right? That's not going to be free. So the bank factoring company will pay less than $300 million, right? So you're not going to get the full $300 million. It's a little bit like a discount, okay? Say it's $280, right? Should the company do it, you're going to lose to $20 million, but you're going to get the $280 million now, right? That is actually a question we're going to be thinking about later in the course. When we talk about net present value, we are going to use an example that is very similar to that. But for now, let's just think about the following, right? It's going to depend really on how bad the company needs the cash today, right? You are paying a significant interest rate, right? Because you are getting $280 million for a receivable of $300. If you think about how this problem works, the company could invest the $280. If the company invested the $280 million at a 7.14% interest rate, you would end up with $300 million at the end of the year. So the implied interest rate on this deal is 7.14%. Okay, so it's as if you are borrowing money at a 7.14%, and the money and your borrowing is collateralized by the receivables that you have. Okay, so selling the receivable really is very similar in economic terms to borrowing against the receivable, right? Let's think about inventory a little bit. Inventory, as you're going to see, is similar, right? We think about raw materials, work in progress, finished goods. Why do companies need to retain inventory? It's necessary for the business to run, right? So you might need to have the finished goods already in place to be able to sell your goods to customers and all that. But the cost is going to be the same as having a receivable. Having an inventory is going to tie up cash because the company has to buy the goods before you actually sell them. So the trade-off we're going to think about is exactly the same, right? So having inventory is necessary for the business on one hand. On the other hand, it's going to tie up cash. Okay, so this is going to be the trade-off in the examples that we're going to talk about in a second. Finally, we have accounts payable, which is the liability side. Okay, so accounts payable are exactly like accounts receivable with a reverse sign, right? If a company increases accounts payable, it might seem like a bad thing. You know, you have more liabilities to pay, but really what you're doing is you're freeing up cash, right? Increasing payables is like borrowing money from suppliers, right? You're telling your suppliers, look, I'm not going to pay you now, I'm going to pay you later. That is going to free up cash for the company, okay? Of course, that might have a cost as well, similar to inventory and receivables, right? If you increase payables, you might affect supply. You know, your suppliers are not going to like it. They might charge you a higher price. They might say, yes, you know, you can do that, but we're going to charge you a higher price for the good. And then the company has to think about that trade-off. It's exactly the same trade-off, you know, but with the reverse sign, right? And that's why we think of net working capital as an investment, right? So we have receivables, inventory, and payables. Net working capital is just the sum of these three items, right? Receivables plus inventory minus payables. So if a company increases net working capital, for example, increase inventory, right? What you're doing is you are tying up cash, but you're making an investment in the business, right? Or if you're buying inventory, what you're doing is you're making an investment in the business, right? It's a short-term investment because net working capital investments will typically generate cash soon, right? So if you increase receivables, the receivables are going to be paid relatively soon. Your goods will hopefully be sold. So that's why we think of net working capital as a short-term investment.